In this presentation, I introduced the second chapter of the book Actuarial Foundations for Life and Health Insurance, devoted to multiple decrement insurance on a single life. The purpose is to move beyond the basic alive-deceased model of Chapter 1. We still consider one insured life and one initial alive state, but the terminal state now records the cause of death. This matters because the amount paid by the insurer may depend on that cause. A typical example is a term insurance contract with an additional benefit in the case of accidental death. The chapter develops the corresponding probabilities, forces of mortality, competing risk interpretation, pricing formulas, reserves, surplus process, and estimation methods. This overview announces the structure of the chapter. I will first explain the motivation for multiple decrements, then introduce the state process and cause-specific probabilities. The central part studies cause-specific mortality forces and competing risks. The final part applies the model to pricing, reserving, surplus analysis, and estimation from exposure and deaths by cause. The chapter extends the classical alive-deceased model to contracts in which the terminal state contains more information than the fact that death has occurred. Instead of one deceased state, the model contains several deceased states, each associated with a specific cause. This is the natural framework when insurance benefits depend on whether death is accidental, natural, or due to another specified cause. A central assumption is that each death is attributed to one and only one cause. This mutual exclusiveness is essential. It allows cause-specific probabilities to add up to the overall probability of death, and it allows the cause-specific forces of mortality to add up to the total force of mortality. The chapter shows that the usual actuarial tools remain available. Premiums, reserves, Thiele equations, and surplus processes are written as in the single decrement model, but with an additional summation over causes, and with benefits that depend on the realized cause. The final component is statistical. When deaths by cause and exposures are observed by age, crude cause-specific forces are estimated by dividing deaths from each cause by exposure. The same likelihood also justifies Poisson regression smoothing. We now introduce the multiple decrement state model. The insured begins in the alive state and can leave it only once, but through several mutually exclusive channels. In this chapter, these channels are interpreted as causes of death. The construction remains close to the two-state model while making the terminal state actuarially informative. In many life insurance products, the death benefit depends on the underlying cause. A standard amount may be paid in most circumstances, while a larger amount may be paid if death is accidental. A model that records only alive or deceased is then too poor because it cannot distinguish the cash flows generated by different terminal events. The same reasoning applies in group insurance. An employee may leave the group through death, resignation, retirement, disability, or another exit. These exits have different consequences for premiums, benefits, reserves, and experience analysis, so they should not be collapsed into a single terminal state when the contract distinguishes them. The chapter also emphasizes a modeling restriction. Only exits over which the insured has no direct control should be modeled in this way. Otherwise, the model may ignore moral hazard behavior. Voluntary choices, such as some lapses, require additional modeling of policyholder incentives. For clarity, the chapter focuses on death with several possible causes. This choice keeps the mathematics transparent while covering the important case of benefits differentiated by the cause of death. The diagram gives the architecture of the model. The insured starts in state E0, the alive state. From this state, several transitions are possible. Each arrow leads to a terminal state corresponding to one cause of death. Cause 1, cause 2, and so on up to cause M. The visual point is that all arrows start from the same initial state and end in absorbing states. There are no transitions between deceased states and no return to the alive state. Once death has occurred, the process remains in the state that records the realized cause. This illustrates the main assumption of the chapter. The causes are mutually exclusive. A death is assigned to one terminal state only. This is why the overall death probability can be decomposed into cause-specific death probabilities. In actuarial terms, the timing of the transition determines when the benefit is paid, while the destination state determines which benefit is paid. This separation between time of death and cause of death is the basis for the pricing and reserving formulas developed later. The stochastic process formalizes the diagram. At duration 0, the insured is alive at age X. At a later duration t, the process is either still in the alive state or has moved to one of the deceased states. The random variable j records the ultimate cause of death. The first displayed relations define the cause-specific cumulative death probabilities. For cause j, this is the probability that the insured has died from that cause before reaching age x plus t. Adding over all causes gives the ordinary probability of dying before that age. The second, displayed relations introduce a complementary quantity, the probability of being alive at time t and eventually dying from cause j. Adding these quantities over all possible causes gives the standard survival probability at duration t. This distinction is useful. For each cause, one can separate the lives who have already died from that cause and the lives who are still alive but whose eventual cause will be that cause. The probability of ultimately dying from a given cause therefore depends on the initial age x. We now move to the central analytical object of the chapter, cause-specific mortality. The single force of mortality from chapter 1 is decomposed into several instantaneous rates, one for each cause. Their sum will recover the overall force of mortality. The first displayed relation is the definition of the cause-specific force of mortality, which is equation 2.1 in the chapter. It is the instantaneous rate at which an insured who is alive at age x plus t dies from cause j during a very short following interval. It is conditional on being alive just before that time. It is therefore an intensity, not a probability over a finite period. The second displayed relation gives the overall force of mortality corresponding to equation 2.2. The total instantaneous mortality intensity is obtained by adding the cause-specific intensities. This additivity follows from the fact that at the instant of death, only one cause can be realized. Once the total force is obtained, the survival probability keeps the same structure as in the two-state model. Survival to duration t is obtained from the cumulative total force over time. Thus, the multiple-decrement model refines the mortality structure without abandoning the classical survival framework. This is the main actuarial message of the slide. Cause-specific modeling decomposes mortality, while aggregate survival remains governed by the sum of the cause-specific forces. The displayed relations show how cause-specific forces generate probabilities over a finite horizon. The cumulative incidence of cause j before duration t is obtained by considering every possible death time before t. At each such time, the insured must have survived up to that point and then die from cause j. The second relation looks forward from duration t. It gives the probability that the insured is still alive at time t and will later die from cause j. The integral now runs over future death times, from t to the limiting age. Again, survival up to the future death time is needed before the cause-specific force can apply. The third relation gives the probability of ultimately dying from cause j. It is obtained by integrating over the entire remaining lifetime. This explains why the probability depends on the age at which the insured enters the model. The chapter also notes that one may define survival conditional on the ultimate cause. This is not the same as removing the other causes. It describes survival within the subpopulation whose eventual cause is known. In practice, data are usually annual. We observe exposures and numbers of deaths by cause between integer ages, not continuous time deaths at every instant. To connect the data with the model, the chapter assumes that each cause-specific force is constant within a year of age. This is assumption 2.3. Under this assumption, the proportion of deaths attributable to each cause is also constant within the year. If cause j represents a given share of the instantaneous mortality at the beginning of the year, it keeps that share throughout the year. The displayed relation for the annual cause-specific death probability follows directly. The annual probability of death from cause j is the total annual death probability multiplied by the share of the total force represented by cause j. This provides a practical bridge between annual mortality tables and continuous time modeling. It also makes clear what is assumed when annual deaths by cause are converted into cause-specific forces or probabilities. The proportional hazards model is a parsimonious specification. It assumes that the force of mortality from each cause is a fixed fraction of the total force of mortality. The constants are non-negative and add up to 1, so they can be read as stable shares of mortality by cause. Under this assumption, the cause composition of deaths does not depend on age. The cumulative death probability from cause J is the same fixed fraction of the total death probability, and the probability of being alive at time t and eventually dying from cause J is the same fraction of the ordinary survival probability. This model is easy to implement because it requires only an aggregate mortality curve and a vector of cause shares. It may be useful as a benchmark or when cause-specific data are scarce. Its limitation is strong. Real causes of death often have very different age profiles. Accidents, cancers, cardiovascular diseases, and degenerative causes do not evolve in the same way over the life course. The proportional hazards model may therefore be too restrictive for detailed experience analysis. We now turn to competing risks. The idea is to imagine a latent lifetime for each possible cause. The observed lifetime is the earliest of these latent lifetimes, and the observed cause is the cause that realizes this minimum. The competing risks model introduces a hypothetical remaining lifetime for each cause. The lifetime attached to cause J is the time at which the insured would die if that cause were the only possible one. Since the insured is exposed to all causes simultaneously, the actual remaining lifetime is the minimum of these cause-specific lifetimes. This interpretation is intuitive. If the accidental death time occurs before the natural death time, the observed death is accidental. If the natural death time occurs first, the observed death is natural. The observed cause is therefore the index of the smallest latent time. The chapter stresses, however, that these cause-specific lifetimes are theoretical. In real data, we observe only the actual lifetime and the realized cause of death. The counterfactual lifetimes attached to the non-realized causes are not observed. This creates an important distinction. The mortality force associated with a hypothetical single-cause lifetime is not necessarily equal to the cause-specific force observed in the multiple-decrement process. They coincide under independence, but dependence between competing risks affects the joint survival function. This slide presents a key conceptual result. Even when the true competing risks are not independent, one can construct independent pseudo-lifetimes from the observed cause-specific forces. The first displayed object is the survival function obtained by accumulating only the force associated with cause J. Multiplying these pseudo-survival functions over all causes gives the observed survival probability of the actual lifetime. This is the content of equation 2.4 in the chapter. The construction also preserves the probability of surviving beyond a given time and ultimately dying from a specified cause, as stated in equation 2.5. The important message is about identifiability. Observed survival and observed cause-specific decrements do not reveal the full joint distribution of the latent competing risks. Different dependent structures may generate the same observable data. Independent pseudo-lifetimes are therefore a useful representation of observable quantities, not proof that the true latent risks are independent. This distinction is crucial when interpreting competing risk models. We now move from mortality modeling to actuarial valuation. Once the cause-specific forces are known, premiums and reserves are obtained by the same logic as before, except that death benefits are summed over all possible causes. The displayed relations summarize the expected present values of premiums and benefits. Premiums are paid only while the insured is alive. Their value therefore combines financial discounting, survival to the payment time, and the premium payment schedule. On the benefit side, there are two components. The first corresponds to annuity-type benefits paid while the insured remains alive. The second corresponds to death benefits. For each cause, the amount payable at death is weighted by survival up to the death time, the cause-specific force at that time, and the discount factor. The principle of equivalence is then applied as in the single decrement model. At policy inception, the pure premium is chosen so that the expected present value of premiums equals the expected present value of benefits over the insurer's commitment period. The formula is useful because it separates the different ingredients: discounting, survival, cause-specific mortality, and benefit design. This separation makes it possible to price contracts where the amount paid depends on the realized cause of death. The first displayed expression gives the mathematical reserve at time t. It is the expected present value, conditional on the policy still being in force, of future benefits minus future premiums. The first term values future annuity benefits and premiums. The second term values future death benefits by summing over the possible causes. For each future time and each cause, the reserve formula uses survival from time t to the future time, financial discounting, the cause-specific force at the future age, and the benefit payable for that cause. This is the direct extension of the single decrement reserve formula. The second displayed expression is Thiele's equation. It describes how the reserve changes locally over time. The reserve earns interest, receives premiums, pays living benefits, and reacts to the possibility of death from each cause. The death term has a clear interpretation. If death from cause J occurs, the insurer pays the cause, specific benefit but releases the reserve. The relevant net cost is therefore the benefit for that cause, minus the reserve held just before death. The surplus process represents the insurer's discounted random profit as information is revealed. Before death, the insurer has collected discounted premiums and paid any living benefits, but it still holds the reserve for future obligations. This is why the discounted reserve is subtracted while the insured is alive. After death, there is no remaining uncertainty for this policy. The death time and cause are known, the benefit has been paid, and the surplus equals the realized final profit. The displayed expression combines the alive and deceased cases in one decomposition. The chapter defines a surplus process as the conditional expectation of the final discounted profit given the history just before time t. With this definition, the surplus process is a martingale with respect to the cause of death history. Under the equivalence principle, its expectation is 0. This means that, after fair pricing at inception, future changes in surplus are driven by random innovations in the timing and cause of death rather than by systematic expected profit. The final section connects the theory with an insurance product and with data. The product is a temporary death cover with a higher benefit for accidental death. The statistical part explains how cause-specific forces can be estimated from exposure and deaths by cause. The figure shows a 3-state model. The initial state is alive. There are 2 possible terminal states, death from natural causes and death from accidental causes. This is the natural structure for a temporary death insurance contract with an additional accidental death benefit. The actuarial interpretation is direct. Natural death has its own cause-specific force and its own benefit function. Accidental death has another force and another benefit function. The difference between the 2 benefit amounts represents the additional payment made if the death is accidental. For a temporary contract over n years, the pure single premium is the sum of 2 expected present values. One corresponds to natural deaths during the coverage period, the other corresponds to accidental deaths. In each case, the payment is weighted by survival to the death time, the relevant cause-specific force, the discount factor, and the corresponding benefit. The reserve follows the same logic. With a single premium, it is the value of future cause-specific death benefits. With annual premiums in advance, the present value of future premiums is subtracted. The slide gives the crude estimator of a cause-specific mortality force. At a fixed age and for a fixed cause, the estimator divides the number of deaths from that cause during the year by the central exposure to risk during the same year. This is the cause-specific counterpart of the crude mortality estimator from Chapter 1. The chapter derives it from a likelihood under the assumption that cause-specific forces are constant within the year. Each individual contributes exposure time and, if death occurs, an indicator of the realized cause. Because causes are mutually exclusive, the total death indicator can be decomposed into cause-specific indicators. The likelihood in equation 2.6 is equivalent up to a factor independent of the parameters to independent Poisson likelihoods for the death counts by cause, conditional on exposure. Maximizing it gives the crude estimator shown on the slide, which is equation 2.7 in the chapter. This Poisson representation is useful because crude rates by cause may be irregular, especially for rare causes. Poisson regression gives a coherent way to smooth cause-specific forces across ages. The conclusion summarizes the contribution of the chapter and prepares the transition. Multiple decrement models handle several causes or exits, but they still allow only one transition out of the initial state. More general multi-state models will remove that restriction. The chapter generalizes single life insurance by replacing the unique deceased state with several mutually exclusive terminal states. This extension is essential when contracts specify benefits that depend on the nature of the exit. The alive deceased process becomes a multiple decrement process while remaining tractable. Cause-specific forces of mortality are the common thread. They determine cumulative incidence, aggregate survival, valuation of benefits, reserves, and estimation. Their sum is the overall force of mortality. So the classical survival model remains embedded in the multiple decrement framework. The competing risks discussion clarifies the interpretation of the model. It distinguishes observable decrements from hypothetical cause-specific lifetimes. Observed data do not reveal the full joint distribution of latent competing risks. Independent pseudo-lifetimes can reproduce the observed quantities, but they should not be interpreted as directly observed counterfactual lifetimes. The framework is powerful for cause-dependent death benefits, but it remains a one-transition model. The next step is to allow richer life histories, including models with several transitions and products covering more than one life,